Why don't we start with Sandra and Niraj? Risk-adjusted return, relative value, real estate versus debt driven largely by market cycles and hence timing. Is real estate debt relatively more attractive in a down cycle as pricing is quicker to adjust vis-a-vis real estate equity?
Yeah, so thank you very much. Our group was, I would say, a good mix of investors and managers. And the first reaction from the investor side was actually to this question, why do you ask about the relative value of real estate debt versus real estate equity? Actually, we as an investor, we look much broader. We compare it always to the whole universe of asset classes in terms of our allocation. But then to answer the question, I think the consensus was it depends on the competition in the market. If there's less competition, there's typically also some mispricing opportunities. And that means that basically in some times there might be mispricing on the debt side, and in other times there might be some mispricing on the equity side. So we would agree that there is some component of cyclicality in this that can provide relative value.
Excellent.
Yes, so our round was very much in favor of the argument that it's a cyclical topic. The discussion mainly evolved around repricing and valuation, coming to the conclusion that whenever the uncertainty about where valuations are going, then it's simply that a position in the debt stack provides for more risk buffer as repricing takes place, especially when at the same time liquidity is scarce, driving the returns for debt, which then as consequence leads to a relatively high return with a lower than equity risk. So yes, the answer of the group was that it's really a cyclical topic.
So also consistent, and I think to one of your earlier questions in terms of timing, it seems like there was more of a yes here, if I read that correctly. So let's move to the second question. Is real estate debt relative attractiveness different based on where you find yourselves in the capital structure? In other words, do you find better risk-adjusted characteristics depending on where you invest in the debt capital structure, and if so, where?
We didn't answer your questions. We had a much better conversation. Well, then, it was free-flowing, but we got, I mean, I'm a little intimidated. They have notes. We don't have any notes.
You just come for the free lunch.
I did. But we did touch on the topic, and I think